How's it going, everyone? I hope you are doing well. I'm sure you're doing much better in previous months. What I mean by that is this is the price action we are currently getting in the month of August. And I'm sure you guys are all feeling the same way. Don't worry. The whole point of this video is to just emphasize on why having a good framework matters so much in trading and why I personally think it matters so much, right? I believe everyone could be a trader. Everyone could be a successful trader. Everyone is able to take a large number of trades. They're able to win a large number of trades. However, where it all goes wrong is when they don't have clear criteria for when to stay out of the market. Everyone focuses on the entry confirmation, focuses on the key levels, on the entry models, and so on. For example, right, let's say you just have a model over here. This is the same model that appears everywhere within the market. And the mistake most people make is they enter every time they see this candle with no context, with no good framework to tell you when to stay out of those markets. Because when you look at, for example, this price action, you get a similar entry model, right? 2 candles, closes higher, but you get stopped out. So this is an example of why having a good framework matters so much, because you don't want to enter every time you see your entry confirmation. You don't want to entertain the market within every market regime. And it goes back to, August price action. And it goes back to the balanced ranges, and it goes back to the imbalanced ranges. This is where you're going to get the majority of low probability conditions, because this is what you have on the volume profile. This is what you have on the higher time frame. You have this balanced range over here, right? Overlapping value area. We come into the balanced range at the start of August. Now remember, August is historically known as a low volume month. Everyone is taking their summer break. For those who are still grinding, like me and you, we're in this together. We're still looking at the charts, right? And we're getting absolutely cooked by it, right? Well, beginners are getting cooked. I'm not getting cooked. You know why I'm not getting cooked? Because I have a good framework. But here, we are in a balanced regime. The market isn't necessarily in a battle of orders. There's no battle of orders here. This is just the market offering fair value. It's offering fair value. Both buyers and sellers are satisfied. Volume is being built here. No one really wants to continue higher. No one wants to continue lower. When you do continue higher, you get responsive sellers stepping in and bringing you back inside the range. So if you look at this price action, we come up, value area, it fails to continue building higher, even though this is still a P shape. The opposing days, we get double distribution, or we get a D-shaped market profile, and eventually responsive sellers step in and bring you back inside the value area. So, these guys, responsive selling. As we come down into here, right, we could potentially get responsive buying and bring ourselves back inside this range. But for now, the normal day in August is pretty balanced, right? You have a lot of D-shaped market profiles, right? For example, here, D-shape, D-shape, D-shape. This is somewhat like, it's still a D-shape, to be honest. And these 3 are D-shapes. So that is the current regime that we are currently playing in within the market within August. So this is where you want to be selective. This is where you really want to have a good framework. You're not spamming trades as much as you was before. For example, during April, during May, where the value area was consistently building higher and you was in an imbalanced state of delivery. Instead, you're taking it slow. You want to be selective. You want clear criteria for when to stay out on the market. And that is exactly what you get here with this framework, with the OBM framework. This framework, the main issue I had before I became a consistently profitable trader was taking a large number of losses. I would go on large winning streaks, right? Every single day would be a win for like multiple days in a row. And then that one day would really mess me up. It would mess up my week. It would mess up my entire month because I didn't know when to stop trading. I didn't have clear criteria for when to stay out of the market. But don't worry, I'm going to teach you guys that. So bear with me. But here, this is what we have. The market has 2 states of delivery. It could either be balanced or imbalanced. Currently, we are in a balanced regime. We have D-shaped market profiles, as you've seen from the volume profile. So this is going to be the norm. This is the norm, and this represents, the balanced range represents fair value. Both buyers and sellers are satisfied at this level. So the best way to trade this, fade the highs and fade the lows. It's as simple as that, right? It's as simple as, like in a nutshell, this is a clear criteria. Anything in between is going to be low probability. And it's the same if you have a volume profile. If you have a volume point of control, let's imagine you have a volume point of control over here. The volume point of control is just a fractal of a balanced range. When you come inside the volume point of control, you would expect a consolidation. So those are the two clear criteria. Once you've identified your balanced range, anything in between is low probability. You know what? You don't want to take anything inside this balanced range. It's extremely low probability. There's no clear one-sided direction. Until we've broken out of the range, this is where you have an imbalanced state of delivery. This is where you shift from balance to imbalance, and this is where you could look to catch those follow-throughs. But in the meantime, when you have this balanced range, you're only looking to fade the highs or fade the lows. It's as simple as that. Anything in between, there's no conviction. There's no follow-through, right? So you only want to play the extremes, which is exactly the price action we had here. And this is why you really want to be patient and sit on your hands. Once you've identified the range high and the range low, where you have passive protection, so passive sellers are protecting this level, passive buyers are protecting this level over here. Of course, you still have to take into account context, the narrative, the intermediate time frame, and so on. But in a nutshell, anything in between here, you could see how low probability it is. The framework gives you a clear criteria for when to stay out of the market. And this is clear. If you didn't have this framework, and you would just be really zoomed in on a chart, right? You have this large move lower, you're looking to catch that retracement, potentially continuing lower. Where's my position tool? Right here. Continuing lower, get wrecked. Same thing again. Continuation is lower, you eventually get wrecked. Same thing again, continuation is lower, you eventually get wrecked. And you fail to see that we are currently trading within a balanced range. Here, this is a balanced range. Clear criteria is to stay out. You don't want to entertain anything until it comes into the extremes. And you can see the type of reactions we get when we come into the extremes, right? Clear buying absorption, passive sellers clearly stepping back in, and price continuing lower. And you could see from the composite profile, right? Let me make it extremely clear for you guys and increase the width of this to 500, right? This is the composite profile. So this represents the day's volume. Where's the majority of the volume? Is in equilibrium, is in the middle of this balanced range. This is a D-shaped profile. You don't want to be catching those breakouts. You don't want to be anticipating for those large expansion plays. Anything in the middle, low probability. Overlapping with this dynamic volume profile, with this volume point of control, right? Low probability. Yeah, low probability. Fade the highs, fade the lows, and you are going to be profitable. You're going to make money within the market. You want to really focus on setting clear criteria for when to stay out of the market and when to entertain the market. When the market is like this, just stay out, right? Donate money to me because you're better off doing it that way. Otherwise, you're going to lose money, right? So clear framework, that's all you need in trading.